Now let's record some transactions where we have to use the accounting matching principle. I have two transactions that I've created for us to work through for a company that I've called Pearson Inc. Let's look at those transactions and work through them together. Okay, so the first transaction, we purchased a one-year software license for $6,000 on November 1st of the current accounting year. Now the payment was made in full on November 1st of the current year. So here's the challenge. The expense that relates to this year is only 2 months out of the 12 months. And using the matching principle, we only want to record an expense of 2 months, not 12 months. However, we paid the cash up front. So let's actually do the journal entry together. Now, cash is going down on November 1st by $6,000. When we decrease an asset, recall that's a credit. Now we have to explain or match the expense to the current year and make sure the expense that isn't related to the current year is recorded as a prepayment. So 6,000 divided by 12 months. Let me just move over here. Is 500. So I'm just going to go 6,000 divided by 12 months. And we have 2 months of the expense relates to our current accounting year. That's November and December. So I'm going to go divided by 12, but times 2. Now at December, we're still owed 10 months of the license. We're owed that, so that's an asset, and we call that asset a prepayment. And that's going to be equals, we're just going to take the 6,000 divided by 12, which we know is 500 a month, and we are owed 10 months of service. Congratulations, we've done our journal entry, our debits match our credits, and we've also stayed true to the matching principle. Now let's do the second transaction. The second transaction is we paid $1,300 of interest expense for the month of December of the current accounting year, but we paid it after the year end on January 3rd. Now, interest is paid at the start of each month to cover the interest expense incurred for the previous month. So here we have to record an expense for the current year, even though we haven't paid that expense. So we're not going to deal with cash in this journal entry because in the current year, we haven't paid or received any cash. But we do have to record the expense because the expense relates to the current year, in particular the month of December. Now recall that when we increase an expense, that's a debit. Now we need to know what's the other side of that transaction. Now it's something we owe, we haven't paid yet. And we call something we owe that we haven't received a bill for yet, or we haven't paid, an accrual. And we'll put $1,300 there. Our journal entry balances, our debit and credit balances, and we stayed true to the accounting matching principle. Okay, now we have a couple more transactions to practice the matching principle with. I encourage you to try and do it yourself first, and then when you're ready, hit play, and I will debrief this with you. Okay, so the company I've made up, in this case is Lori Inc. There are two transactions. We need to make sure we are using that accounting matching principle. And the first transaction, let's read it. We purchased a one-year property insurance policy for $12,000 on October 1st of the current accounting year. So we have that insurance policy covering us for October, November, and December, so 3 months of the current year. Now the payment was made in full on October 1st for the full 12 months. So we know that when we decrease an asset like cash, that's a credit. But now we need to use the matching principle. We're not going to record the total $12,000 expense in the current accounting year because we're only enjoying 3 months of insurance coverage. So I'm going to take that $12,000, divide it by 12, which works out to an insurance cost of $1,000 a month. And we had 3 months of insurance coverage in the current year. So that's the expense using the matching principle. However, we're owed another 9 months of insurance coverage next year. Because we are owed that, it's an asset, it's a prepayment asset, and the amount of that is going to be $12,000 divided by 12. That's the monthly cost of $1,000, but we get 9 months of coverage next year. Our debits match our credits, and we've used the matching principle. Okay, now what we're going to do is we're going to do a utility expense. Here we paid $2,500 of electric utility expense for the quarter ending December, but we paid just after the year end on January 10th. Typically, the utility expense is paid at the start of the month following the end of the quarter. So here we have an expense relating to the current year but we haven't paid any cash. So we're not going to touch cash, but we have to record an expense. When we have an increasing expense, that's a debit of $2,500. So we need to have a credit somewhere to balance that out. And it's something we owe. We still owe that utility expense at year end, even though we might not have even got the bill. We know that we incurred that expense. That's an accrual. It's a liability. Our debits match our credits, and we've honored the matching principle. Another incredibly important accounting concept that involves adjusting entries is something called depreciation. Remember in our original balance sheet example, we purchased equipment with a value of 80 and recorded it as property, plant, and equipment under non-current assets. Let's now assume that the equipment has a useful life of 4 years, and that we're going to use that asset very evenly over those 4 years, and that at the end of the 4 years, we believe the asset will have a value of about 30. In other words, we'll be able to sell that used asset for 30 in the market. We call that a residual value or scrap value. You can see that we have an expense that needs to cover multiple years. So we need to spread the cost of this expense over the asset's useful life to ensure we're still aligned with the matching principle. So let's see how we do this. We can spread the cost or expense of an asset used for more than 1 year using several different approaches. The most common depreciation expense approaches are straight line, units of production, and double declining balance. To calculate depreciation expense in each of these approaches, we need to understand several factors such as the cost of the asset, its expected useful life, how we're going to use that asset, and its salvage value. A business needs to typically select the depreciation expense approach based on which approach most closely matches how the asset will actually be used in the business to generate revenue. Let's now explore each of these 3 approaches in a bit more detail. By far, the most common depreciation approach out there is something called straight line depreciation. This approach assumes that the asset will be used in the business really consistently over its useful life. So here we have an example of an asset that costs $25,000, has a useful life of 8 years, and is assumed to be worth nothing at the end of its useful life. We're assuming we won't be able to sell it for anything. Dividing the $25,000 initial expense by an 8-year useful life gives us a consistent depreciation expense of $3,125 each year. Let's now do another example where we actually do have some scrap value. So let's say we purchase the equipment for $80,000. We expect it to have a useful life of 4 years, after which we think we'll be able to sell the used asset for $30,000. So in this instance, the cost of the asset for the business is not $80,000, it's only $50,000, as we'll be able to sell the asset for $30,000 at the end of its 4-year useful life. So we only take the cost of $50,000, not $80,000, and spread that evenly over 4 years, which would give us an annual depreciation expense of $12,500. Let's look at how the journal entry would work for this transaction. We know already that increasing an expense is a debit. As depreciation expense is just that, we're going to debit depreciation expense. Now we need to look at the credit side of the journal entry, and we're going to create a new account called accumulated depreciation, which sits on the balance sheet. We call this type of account a contra account, or a contra asset account in particular, where contra means against. In the case of depreciation, what we're going to do is set the balance in the accumulated depreciation account against the corresponding property, plant, and equipment account. Let me now take you through how this looks each year from year 1 to year 4. Now, the accumulated depreciation contra asset account is going to sit right on the balance sheet next to the corresponding asset account. So you can see that we still show the original cost of the asset, but we net off depreciation of $12,500 to give a net balance of $67,500. This balance is referred to as an asset net book value, where net means after deductions. I also like to think of the financial statement reader. So, another way we can kind of explain this is think about it this way. What we're trying to communicate to that reader is that of the original 80,000 we spent on the asset, we have expensed so far 12,500, but we still have another 67,500 to expense in the future. Let's now move to year 2. Because it's straight line depreciation, we're going to expense another 12,500. And the journal entry is going to be debit depreciation expense. Remember, we're increasing an expense, so that's a debit. So 12,500 goes there, but we're going to credit the accumulated depreciation contra asset account, also with 12,500. This is going to increase that accumulated depreciation account balance on the balance sheet from 12,500 to 25,000, which is going to also reduce the net book value of the asset now from 67,500 to 55,000. If we look forward to the ends of year 3 and 4, again, we're going to expense 12,500 each year with the same journal entry I just talked you through. Now, recall that at the end of year 4, that's the end of the asset's life, and we're going to sell that asset for 30,000, which matches the net book value on the balance sheet at that date. Now, let's look at another popular depreciation approach. It's called double declining balance. Now, this method is really the most appropriate where an organization expects to get more value from an asset at the beginning of its useful life. The equation to calculate depreciation using this method is 100% divided by the useful life of the asset multiplied by 2, which really doubles the decline, and then we multiply that by the opening balance or opening net book value of the asset. So here's the same asset we saw before that cost 25,000, has no scrap value, and will be used for 8 years. Let's calculate depreciation for just the first year. Remember, the formula is 100% divided by 8, which is the useful life of the asset, multiplied by 2 to create that double decline, and then multiplied by 25,000, which is the opening balance. This gives a first-year depreciation figure of 6,250, which is double the depreciation expense of 3,125 that we calculated using straight line. Our final depreciation approach or method is called the units of production method. This approach expenses an asset based on its exact usage. The more the asset is used in a period, the higher the depreciation expense. So, for example, taxi companies could depreciate their vehicles based on their expected mileage. An industrial-grade coffee machine could use numbers of shots or cups of coffee. Given that those cost drivers are also used to determine the repairs and maintenance costs of those assets, the units of production method often makes sense. Let's use the same example we've seen already with an asset costing 25,000, 0 scrap value, and an 8-year life. However, for this method, we also need some additional information. Let's also assume this piece of equipment will produce 50,000 widgets over its useful life and is expected to produce 2,000 units in the first year of use. The first thing we need to do is calculate a percentage of widgets this year versus total widgets. So if we take 2,000 for this year divided by the total of 50,000 over the useful life of the equipment, that works out to 4%. In other words, we're saying we should expense 4% of the asset in the first year. Now, 4% of 25,000 works out to 1,000, which will be the year's depreciation expense.